probably hear a lot of ICT traders talk about market structure and just why it's so important. And if you're anything like I was, I had no clue what they're talking about. And the problem isn't you, it's that market structure is such a broad term and you need someone to bring it under one umbrella and teach it simply. In today's video, we're going to be going over the entirety of market structure consolidated into simple topics, and we're going to look at the most big, main, and efficient ideas that you absolutely need to know to become a successful ICT trader. So let's hop on them slides, boys. All right, so let's just dive straight into market structure, right? First, what is the goal of this entire video, right? We're going to develop a top 1% fluency of the truth behind real effective market structure, right? None of that ICT brain rot stuff where it's all these small concepts that you're going to learn, forget about, and never use, right? This is real market structure, right? And understand, coming into this, if you see something not work on the charts, don't be mad at me, right? The market is simply a playground of probabilities, right? It's not code that this happens and this has to happen, right? Not everything in this video is going to work 100% of the time. So without further ado, let's just hop straight in, right? This right here is the kindergarten of day trading, right? Foundational concepts, right? This is all about market structure that you have to learn if you are just getting into trading, right? So most of us already know this stuff, right? So let's just hop in. First, highs and lows, simple concepts, right? High is here, a low is here. A swing low is going to be a 3 candle combination, right? Where if you see here, there's 3 candles and the middle candle is the lowest. It has the lowest wick low, not the body low. Don't look at bodies, right? For swing highs and lows, simply look at the wicks, right? That's the actual lowest price. So swing lows here, swing highs here. Very simple concepts, right? Next, we have hierarchical order flow, right? And this is a bit of a complex concept if you don't understand it simply, right? The lower time frame's true direction, like anywhere from the 15 minutes to the 1 minute, all that stuff, is going to be dependent on the higher time frames direction, right? So if you look at this little diagram here, right, the 4 hours direction is going to be dependent on what the daily's direction is, right? And that daily retrace is going to be a 4-hour break of structure, and the 4-hour break of structure to the upside is going to be the continuation of that daily retrace, right? The 15 minute is going to be mirroring the 4-hour, right? It's simply just saying that the lower time frame's true direction is going to be dependent upon what the higher time frame's direction is. And I don't believe in time frame alignment. Let me make that clear. If you've watched YouTubers who believe time frame alignment, if you hit a 1-hour PD array, go to the 5 minute, all that kind of stuff, don't believe in that stuff. The model that the market actually moves upon exists on whatever it's clearest on, not what just the perfect 5-minute time frame and the 1-hour time frame, because who decided that, right? You decided it, you run the market, like, no, right? So an explanation that I believe we all should know as traders that really simplified how we all trade so similarly for me is this, right? Every trade is simply a setup executed on the low time frame in line with the high time frame direction within an area that the high time frame expects to continue towards its higher time frame draw liquidity from, right? So simply put, the higher time frame is a skeleton, right? It's a framework and it's a blueprint, right? And after a retracement on the higher time frame, in the insertion of a high probability, low time frame quantification of the change in directional order flow, that is your confirmation of trade, right? And if what I just said sounds like, huh? Understand it simply. Higher time frame retraces. Once you get your entry model on the lower time frame is when you trade it back to the high that the higher time frame left, right? That's simply how that's how we all trade, and that's facts, right? We wait for that retrace and we get that quantification of a change in order flow, right? And that's your setup. It might be SMT, change of the state, inverse value gap, whatever it ends up being for you. That is your quantification of a change in order flow direction. That's a smart money reversal, right? And this is going to be true for 99% of trading systems. These are fundamental truths to the market. Even if you don't trade ICT, I can most likely look at your system and say, yeah, that trade, 90% of your trades are going to be something that I might take as well, simply because we're both looking at the same charts and our ideas are derived from the same thing, right? So even though we have different religions, they live on the same world, right? But they have different ways of explaining certain things. Same thing with philosophy, right? It's the same concept within the market. And that's just facts, unless you trade indicators, algorithms, whatever you trade, right? But for most price action trading systems, it's going to be truth. So we should all know this. Finally, imbalanced price action, right? This is a pretty simple concept. When price moves sharply to the upside without proportional retracement, right? So watch this. Price is consolidating, giving equal opportunity for both sides to get in. It moves sharply to the upside without proportional retracement, then sustains that level, right? Buyers that place orders below the current price do not get filled in this move higher, right? So understand the order book, right? At the current price, there is going to be sell limits above price where there's buy limits below price, right? If price retraces, it taps in buyers and then continues higher. If it pushes higher, it taps in those sellers and continues lower. Whatever it is, right? Whatever the narrative tells you the direction of price is, that's how it's going to work, right? So understand here, when the market just moves mostly higher without proportionally retracing back, we're leaving a lot of buyers that want to get into positions but don't. And what is the market's job? It's to facilitate market exchange efficiency, right? We talked about this in the last video. Instead of I find you, I want to sell, you want to buy, let's exchange. No, the market does it. It acts as our counterparty and does it like that, right? So its job is to match those orders and get them all working efficiently. So it's going to retrace to tap in the buyers, and it's going to seek that most efficient area, right? It's going to do it to get the majority of those neglected orders, right? Here's an example. When price sits here and consolidates, giving both sides opportunity to get in, move sharply to the upside, consolidates again. If we see this and the market decides to, we can expect a retracement that for value gap, hitting 50%, whatever we want to hit, whatever is the most efficient zone within this area, and then it continue back to the upside, right? It's really that simple. And this is the definition of the exact same, right? So it only gets those sell limit orders in, none of the buy limits, right? So now the market pulls back to the most worth it area, or the technical speaking most efficient area, where it can get in the most buyers within a reason, given all the algorithm and the variables and all that stuff, right? And then it continues in the bigger time frame direction, right? If you hear traders talking about the most efficient area, what they're surely saying is the area where price has the most resting orders and it's the most efficient for price to go ahead and seek, right? That's the facts, right? So finally, you guys passed kindergarten at day trading. Now we can get into some of the real concepts that you actually use every single day. Of course, you use these, but these concepts will really, truly be like, hold on, they'll be eye-opening to you, right? And most of us know this stuff, right? But these are the essential concepts of trading. Number one, fractality, right? All of us pretty much know this, or we've seen it, or we're about to get our eyes open, something like that, right? So on the higher time frame, say the 1 hour, if we see some kind of structure like this, so that's a market maker model, right? Sell curve, buy curve, retracement for value gap. If we see some kind of structure like this and we zoom into this little spot right here, now we go ahead and look on the 5 minute. It is most likely a fact that we are going to see very similar structure to the hourly that we saw in the 5 minute, right? So looking at this, it is going to be the same exact generation and then market maker model to the upside efficient move, right? That is just how it works, right? Every single retracement on this higher time frame is going to be something just like that, right? So 5 minutes looking something like this. Now, if we go ahead and zoom lower on the 5 minute, what do you think we're going to see if we go to maybe the 15 second? It's going to look the exact same. And that's just facts, right? That's how the market works. We have to understand that the market is fractal, right? So zooming all the way back out, we will see something like this. If we zoom in, if we were able to graphically show this, right, we would see the 1 hour time frame generating, we see displacement, we see the 5 minute comeback generating, and its rebalance to go ahead and run higher on the 1 hour time frame. If you zoom into the 5 minute time frame, you're going to see that same exact model, and in 15 seconds, the same exact thing. So now use this to your advantage, right? You can understand it conceptually, but you can also trade like this. That's why I take overlapping internal model trades, right? The trades that I will usually take are going to be 15-second trades right here. So where we see displacement 15-second, pullback, then I just traded this 15-second model, right? I'm simply taking my first take profit at the high of that model, and then I'm leaving runners all the way to this 5 minute draw. And if I'm crazy, maybe it's that hourly draw, right? But it's unlikely to see price move that much within a day. So that's how you can actually use this to frame trades. The next thing I'm going to take straight from last week's video, this is going to be over AMD, right? Accumulation, manipulation, distribution. Now, simply put, this is how it's going to look like if we graphically represent it on a line chart. We're going to see accumulation, right? We talked previously about orders, right? There's orders below these areas, right? And we see price manipulate, right? Now, once we generate all that liquidity accumulated over here, we're going to see manipulation, right? Manipulation will usually happen when we're within some kind of bigger time frame for value gap right here, or within equilibrium of the range, an area in which we expect to reject in the higher time frame, or we have confluence, SMT, whatever, right? We're going to see manipulation once we hit that area, right? And usually this is going to be when time and price are aligned, right? So news events or macro times or market open, whatever it ends up being, that's when we're going to see manipulation. And then from there, we'll see displacement through a low, which validates us to now go ahead and take a trade to the downside, right? So that trade to the downside right here, after we put in our entire accumulation manipulation structure, we expect to see D or distribution to the downside, an efficient run to go ahead and take out all that liquidity, right? That's how this works. That's AMD. And all this together is what creates a market maker model, right? That's exactly what it captures. And this is how the market works. Because if the market runs off of AMD and we understand the simple market maker model framework, we can trade exactly what the market actually does, not just a silly kind of derivation of what the market actually does, where we simplify topics. We can actually understand what the market is doing, how it's generating liquidity for itself to go take later, how institutions literally use this structure to make tons of money all day long. Once we understand those things, we can actually trade alongside those institutions, and that's what's so rewarding about this entire process and understanding, right? So that's AMD, and that's something that we all have to understand, right? And keep in mind that this is the exact same thing as the AMD model is the same thing as the market maker model, right? So zooming back out, that fractal model I showed you guys earlier is the same exact thing we just checked out, right? We're tapping into some kind of bigger time for fair value gap. Most likely time and price are aligned. We see 5-minute retrace, 15-second trade all the way to the downside, right? That's a lot of the way that I get really high hour setups. The 12-hour trade I took a couple days ago that ended up getting stopped and then running in the direction. That was with this exact model, right? 1 hour is aligned, 5-minute is aligned, 15 seconds is aligned. Everything looks really great to go ahead and take a trade, and you go ahead and trade the straight down move, right? That's how the market really moves, and that's AMD. So the next concept that we need to take a look at is liquidity, resistance, and rebalancing, right? So let's define these three terms first. Liquidity is going to be just simply put resting orders, right? The markets draw towards these points, and these are at highs and lows, right? We talked about that earlier within the highs and low points. Liquidity is going to be resting at highs and lows, and that's why the market draws to those points, because we talked about this in the narrative video. The market's job is to efficiently facilitate market exchange, right? To do all through that fintech computer algorithm, so I don't have to go seek out Betty over there who wants to sell when I'm looking to get into the market and buy, right? So the market's job is to do that. It's going to pair us buyers and sellers efficiently by moving price to the areas where we place our orders, all that, yada, 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 right? That's how liquidity works, resting orders. Next, resistance. This is the difficulty for price to sustainably move through a level. What I mean by sustainably, but the market breaks a high and actually rests above it and then continues higher, right? It doesn't just get above it and then continually move down, right? It's not manipulation at that high. It's a run of that liquidity, and it now feels like it owns this area like it should be here. Not like it's fighting to stay above this area and then eventually drops, right? Sustainably move through a level, not just sweep it and stay right at the same level as it, through the level and hold, right? That's resistance. Next, rebalancing. This is exactly the same thing we talked about earlier, right? This is the recuperating movement back inside that range that gets created from the sharp move in either direction without proportional retracement, right? And the market can rebalance to 4 points, right? Imbalances or fair value gaps, right? It can rebalance to range equilibrium or OTE of a range, and that can be on the previous range in the current price leg, whatever you want to draw it on, the higher time frame, lower time frame, whatever. Or it can be on the entire market maker model range, right? So say we're in a sell model, you draw that out from the current area that we're at within the sell model, can retrace the equilibrium and then continue dumping. It can also rebound to consequent encroachment of a bigger time frame or even a lower time frame wick if it's a news wick, something like that. We can also rebound to order blocks, right? So these are the points we can expect the market to rebound to, right? Now, before we get into this, there's one more thing we need to understand, right? Buy stops being hit triggers market orders, right? And it triggers market buy order, right? So when your buy stop gets hit, it triggers a market buy order, right? Market buy orders advance the order book higher, right? Sell stops being hit trigger market sell orders, right? And sell orders advance the market lower, right? Market sell orders do that. So now we understand that. Why do we know that? Because check out this diagram, right? At highs, when price is at this level right here, right? Price is currently below this level. We're going to be seeing sell limits placed, right? Because sell limits get placed above the current price level and buy stops get placed above the current price level too, right? So if you want to buy above current price level, it's going to be a buy stop. Sell above, it's going to be sell limit. And the same is true for the opposite side. Sell below, sell stop. Buy below, buy limit, right? So you usually see buy limits placed at those lows, sell stops at the lows, sell limits at the highs, and buy stops at the highs, right? So now reverse this and say we have some kind of structure where there's a ton of sell limits at that high, right? That is going to be a high resistant high because as we know, sell limits get hit, right? It's going to give us confluence and it's going to give us selling pressure to continue pushing price lower, right? When sell orders get triggered, price gets pushed lower, right? So when we see the market go ahead and tap that area, we can expect that to now be a liquidity sweep to go ahead and push price lower, right? And that's what we have to understand about price, right? If we have an order in a high resistant high, right, and high resistant highs usually are going to be highs that already took liquidity. So we have some kind of generating structure, and then we have manipulation. That's usually going to be some kind of high resistant high that if we rebound, we might want to sweep. So we'll have to just really watch and react what the market does. That's the biggest thing. React. Don't predict, right? Don't predict there's going to be a liquidity sweep. Simply react. You'll be able to tell 100%. Next, let's reverse this, right? If there is no or very minimal sell limits at the highs, but there is buy stops at the highs, and usually you'll see this happen in a configuration like this, right? Where we have a ton of resting highs, right? These are low resistance highs. We see buy stops resting above every single one, and we know that buy orders push price higher. When price breaks through a level, taps this area, this green area right here, it now gets fuel to continue pushing higher. So if we watch price after we've broken through one of these levels, now we can expect to see price maybe pull back, find some area of support, and continue pushing to the highs to end up taking out and finishing this entire sell curve and buy curve, right? Understand that each of these is a low resistant high, right? Each of those are what makes low resistance liquidity, right? So now let's split this into two. This leg on the left here, this is a low resistance run, right? Low resistant run, whatever you want to call it. This is what we'll see in a low resistant liquidity run, right? This move is going to be very quick and efficient, right? There's going to be fair value gaps left in the leg. Maybe they get tapped and maybe they don't get tapped. But if they do get tapped, we're usually only going to pull back to maybe somewhere around 50%, even if that, no more than 50%, and then we'll continue efficiently back to the upside, right? That is what we're going to see in a low resistant run, right? It's going to be very quick and visibly faster than everything else on the chart in that current model, right? The other thing that we see, usually on the other side of this, right? When the market moves higher, low resistantly, it's going to move lower, high resistantly, right? So that's kind of a mouthful, but just understand that, right? The high resistant run is going to be you can tell this stuff visually, right? It's going to be very slow, lethargic, and it's going to be visually generating that liquidity, those buy stops above those highs for the market to go ahead and run later in that low resistance liquidity run, right? And this is key to understanding. And what makes that low resistance liquidity run so efficient and fast is efficiency, right? And efficiency is only possible because two things. Number one, narrative is aligned on the higher time frame, right? The higher time frame actually wants to go higher, so the lower time frame is going to be better. But the more stronger one, in terms of the current model in which we're in, efficiency is only going to be possible because the structure validates it, right? And that structure is going to have that low resistance liquidity that will be buy stops or sell stops or whatever to act as fuel to push the market lower, right? Or to push the market faster, right? So if we see a straight up move, that's usually not going to happen a lot, right? And if narrative is aligned to push higher after we see a very fast move lower without any generated liquidity, that move higher, while it will still happen, is most likely going to be very slow, right? And that's what we saw today in the market, September, 9th, I believe. We saw that today. So that's just an example of how narrative and structure combine to create efficiency. And that's what next week's video is going to be going over, right? So that's what we need to understand, right? That low resistance liquidity is structure that we need to be able to know that we're going to see an efficient run. So let's go ahead and understand this concept now. When we have displacement, and we've already talked about this a couple of times, when we see that big sharp move, which is displacement with the fair value gaps left in the leg, and we don't see proportional retracement, so equilibrium of the range, in terms of that entire leg, we don't see proportional retracement back. Now we understand we could potentially see a rebalance, right? The market's going to rebalance to these same 4 points: equilibrium out to E, CE of a wick, imbalance for value gaps, or order block. So let's go ahead and mark out what do we have here, right? We have a bullish for value gap, order block. We have equilibrium of this range right here, right? Zoom out, maybe this would be a candlestick or two. Equilibrium of that range. This is areas that if the market wants to start pulling back, we can expect to find support on the most efficient area here. And simply understanding the most efficient area is going to be the area that price wants to seek, and that will usually be where there's overlapping confluences, right? So on this equilibrium line, we have 3 overlapping confluences. That's looking pretty good to go ahead and see the market reject it. So if we start to see the market push lower, setting up for a lower resistance liquidity run, look, slow lethargic move. To move this distance, we're going to do it in like 3 times the amount of time that we want to see this now buy side of the curve happen. We see every fair value gap that gets placed in that leg gets tapped back into. We see shallow move. It's lethargic and it's visually generating liquidity is the key of this, right? From there, the market can do 2 things, right? If it wants to go lower, I'm going to let it go lower, right? I don't care that my trade idea was wrong because my idea doesn't mean anything until I actually get confirmation, right? I don't care. I didn't take a trade. I didn't take a loss. And because of that, I'm completely fine watching this and letting that trade idea go. And the market can also sit sideways, right? If the market doesn't want to do anything, just let it do nothing, right? But the market can also move higher, right? So if I see the market start to move higher and I see it visibly break above one of these highs with displacement, giving my change of the state, mark structure shift, mark structure break a structure, whatever you use, if you see that happen, now you can look to go ahead and get involved and take a trade to the upside. So price will find support and continue pushing low resistantly to the upside with efficiency, right? That's how I trade. That's how everybody trades, even if they realize it or don't realize it. Most people are going to be trading something very, very similar to this right here. Now, finally, let's move on to the final essential concept, right? The final piece of meat from this video is going to be displacement, right? Displacement is a strong, weightless, sustained break with candle closure through a given level, which is usually a higher low, right? The vocabulary here is the most important thing. And if it doesn't click with your brain, you're going to see some examples later and you're going to start to understand it, right? The vocabulary, the strength and the weightlessness of price once it's gotten above that level is what is going to give you key that this is real displacement, right? Displacement is a liquidity run. It's not any kind of liquidity sweep. So let's check out an example here, right? When we see this on the left here, where price visibly breaks much higher above this level, right? Look at the difference between this level right here and the area where price closes, right? There is a visible difference between the two, right? Price closes much higher above candle closure displacement. Boom. That's something I'm willing to go ahead and take a trade if the higher time frame now validates me for that. But over here, where we see we shallowly move above that level, we can now expect that maybe to be a liquidity sweep or manipulation to simply just continue pushing lower. Don't get faked out. Displacement's whole thing is that it's stupidly obvious, right? And the more you try to objectify it and understand it and be like, wait, that wasn't displacement, is this, like, truthfully, the more that you're going to start messing up. You have to understand the simple subjectiveness of displacement, and that you have to let it happen, not look for it everywhere, because displacement is only going to happen when it's true. And if it doesn't happen truthfully, save yourself a trade. Don't get stopped out. Don't expose yourself to lower winning probability. That's the thing right here. And these definitions of that, so I'm not going to read out, but if you want to understand the difference, these are the best ways to understand it in my opinion. So pause the video and go ahead and read those. So next, we have to look at why displacement is so strong, right? Displacement is simply put the truth behind a change in order flow direction. So we have those break of structure, market structure shift, change of state, market structure break, whatever it might be. Those are ways to quantify displacement, right? The only exception to this rule is going to be inverse fair value gap, because that's simply a change in order flow before we get displacement, right? So inverse fair value gap is going to be the one that comes before displacement or any of this. It's going to be the least confirmation, but if used right, many people make a lot of money with inverse fair value gap. So overall, good concept nonetheless. But understanding that displacement is quantified as those. So really, those are simply watering down displacement, and the concept is displacement, because when you get true displacement that validates a trade happening, you will usually see break of structure, market structure shift, change of state, market structure break. All of those four concepts that are similar but different are usually going to happen on a true displacement. They're all going to be met in some way or another, right? So that's true displacement. The more displacement through a level, the better generally. But understand that very unreasonable, fast and large displacement is most likely going to be a fake out, right? Is it usually stems from an injection of volatility into the market from news or just simple market manipulation, right? When the market moves way too fast, your best thing to do to discern is this, right? Watch the directional reaction after we get that candle close. So if we get change of the state and we're not too sold, is this displacement? Is it not? Watch the directional reaction. If the market immediately starts pumping lower, right, even past the change of state level, it doesn't even find support off of that, it continues pumping lower, that's most likely going to be some kind of fake out. We might expect that low to get taken one more time before we see the real displacement in the go, right? However, if we continue moving weightlessly above price, right, that vocab word, that understanding, weightlessly, price is finally unchained, it's moving nicely above that level, that's usually going to be true displacement. Now, let's put this all together for a real trade, right? We all just passed high school. We're not ready to get into this stuff, right? So this is our 1 hour chart, right? And this is something, if you think I'm just making this up, I've seen this happen a ton of times, bro, trust me. And if you understand this analysis, great, because it's very simple, and this is how the market actually is too. So the 1 hour time frame, right? Let's do some top down on this. Let's understand currently it looks like we're in some kind of market maker model, right? So sell curve, buy curve, we're within some kind of, after we've seen market structure shift, wherever you want to market here, it doesn't matter, because we've completely invalidated this entire area of imbalance price action, right? So when we run through that quickly with displacement and we're now sustained above that level, that gives me confidence that we've now changed direction or order flow, right? We also have low resistance liquidity to the left, right? We usually have some kind of narrative that is the reason for us bouncing here. And then as well, we've gone ahead and placed relatively equal highs right here, and we're expecting markets to open soon. We're now generating liquidity, rebouncing, boom, boom, boom. Looks really good to see continuation to the upside. There is nothing inside me that wants to take a short unless market open validates it to me. But 9 times out of 10, even with this kind of bigger time frame structure, I'm not going to be looking for any kind of short. So zooming lower now. Let's look right here. What do we have, right? We have a ton of confluence system market. We have a bearish fair value gap. We have equilibrium with this leg. We have lower resistance liquidity sitting here. We have higher time frame overlapping jaws and liquidity with the internal model and the external model. Now we have market open right here at this white line. Let's go ahead and watch what we do, right? So on market open, we continue pushing lower, rebalancing, and we go ahead right when market opens, we push lower and we manipulate, right? That's when we place in that SMT on that level. Within the fair value gap, within an area in which we already expect to reject, we see the sign of manipulation, which is the SMT. So we see manipulation within an area in which we expect to reject. That is a very strong sign for me to now go ahead and look for a quantification of change in order flow, which is going to be your entry model, your setup, whatever. For me, a change in the state with displacement. So I see that, I go ahead and take my trade to the long, and boom, we bank, right? Now your first take profit right here would be the end of this internal model right here, and you could have left runners with a break-even stop to this external model, and then maybe even zooming out, you could have left runners up to one of these draws up here, right? If price continues upside level. But understand here, I got that small piece of the pie, and dude, I am happy, right? You can make so much money with those small pieces of the pie. You simply put more contracts in, right? We all know that simple stuff, and that is what we want to be doing. We want to be catching those low-hanging fruits, because that's where we see consistency in trading, right? Not catching the big home runs from here all the way up to here, right? No, we just want to be catching these low, small trades, these scalps that are very high probability, right? And that's what we want to be doing. So that has been market structure. And if you feel like you maybe didn't learn a lot, or you feel like you just kind of worked on fluency, maybe you feel like your entire world's been open and you're like, hold up, like what is all that? Go ahead and watch my videos, because this will show you this isn't just some kind of skill that you understand and maybe you use a little bit. This is the truth about market structure. It's not none of that intermediate term high, all that kind of stuff, right? No, this is real market structure. This is actually what the market does with those highs in terms of orders, how it actually moves based on those highs, right? Intermediate term highs, all those concepts are simple concepts that are created to explain these things that the market structure literally tells you, right? Displacement, low resistance liquidity, higher time frame draw, imbalances, invalidation of order flow, all that kind of stuff. It's so simple. It's up to us to simply just understand it in terms of market structure, because that's the only thing that's real and 100% guaranteed in the market, because we can draw a fair value gap or standard deviation projection 10 different ways among 10 different people, but the same fair value gap on the chart at 9:32 every single morning is always going to be that same fair value gap on every stop time. So without further ado, I'm going to let you boys go. If you have anything to comment, anything to help me add, go ahead, drop the comment. I'll be first to respond. And I thank you all for listening. Hope you guys can learn something from the video. So without further ado, I'm going to let you boys go. Peace out.